Hello, everyone. Joe Mass here again. Hey, I guess I wasn't kidding last week when we shot the last video, and I said that my intention wasn't really to film a Stay Calm, Carry On video every day. Of course, I didn't know we were going to have to, but you know what? We will. We're on this. We're watching this market, this black swan that we're having. So don't worry, I'm not sleeping. I go to bed at 2, I'm up at 4, and we'll put out as many of these videos as we think will help you stay calm and carry on. Now, when I say stay calm and carry on, that does not mean to do nothing. That doesn't mean that we aren't taking this as a serious black swan and that you should do nothing. It just means stay calm, carry on. We're working 24/7 for you, and we're going to go through today some of the reasons and the evidence that we hope will allow you to sleep. Okay, so we'll try to keep this as short as possible. We could be talking to you 24/7 because as things are changing every day, every 15 minutes, it seems the world has changed. And again, me and our teams here, and your primary relationship managers. We're working overtime. We love it. This is what we're built for. And we're really excited that we can serve you through this. So, over the last week, I've been asked probably 100 times, Joe, how you doing? How you doing? And I'm like, well, why is everybody asking me how I'm doing? And it dawned on me, I'm like, oh yeah, because we're right in the middle of a black swan. But I am fine because I know that we're doing the best job we can. We are using the preponderance of the evidence. We're using all of our tools. We're making good decisions. We're not reacting too fast. We're not reacting too slow. And with this amount of uncertainty, I'm just very comfortable with how we're making adjustments. Now, are we perfect? Can we predict the future? Of course not. Do we know what's going to happen? Of course not. But we can control our duplicatable, systematized, institutional fiduciary processes. And so I'm resting very well because I know we're doing a very good job. So we thank you again for letting you trust us. I take it as a great responsibility and privilege. And this is what I'm built for. I've done this for 30 years. I've been through this before. Again, this is different this time. This isn't like 2008. This is not like the other market events that we've had, but I feel well prepared. And our teams are performing very well. And in such a sobering time, I am very energetic. I get a lot of energy and passion to serve you, and so thank you. Okay, so let's see what we can do here. Stay calm and carry on. So that's me again, Joe Mass, Chief Investment Officer, and again, it's our privilege to be working with you and managing your money. I'm going to give you a quick introduction. We're going to give you a quick overview again, talk about investing, and we're going to finish up with the markets. We're going to talk about what we've done, what we will continue to do, and then what you should do. Okay, so, you're watching these. I kind of start with this every time, and it's very important just to take a couple seconds to put everything in perspective. And so there is no such thing as a perfect investment, right? We've learned that. But if there was one, it would never lose money. It would always be liquid, and it would always get you double-digit returns, right? And so we know that that's the pink unicorn. That does not exist, okay? But what does exist is that we have great options through financial planning processes, through the ABC processes, through the retirement process, okay? Through good planning, we know that we can build a well-diversified portfolio. So, you get some liquidity with some protection, right? Option B, you get some protection with some gains. And of course, C, the red money, is where you get stocks and bonds and you get gains, but not a lot, and liquidity, but not a lot of protection. So if you have a little bit of your monies allocated amongst those strategies, ABC, if you have some of your monies allocated across a good financial plan, that's really the secret sauce to driving the portfolios, and it should help you rest at night. Now, if you don't have a financial plan, right, you might not be as comfortable. So if you feel your plan needs to be adjusted, meet with your primary relationship manager and they can get your plan squared away, okay? Again, you need to have a parachute before you get on the plane, not after you're on the plane and you decide you need one. So a good plan, a good ABC plan, keep it simple, ABC. A good plan is a great remedy to these volatile markets, and you got to have a plan ahead of time before that black swan hits, okay? If you don't, it's okay. We'll get you squared away. Just let us know, okay? All right, so investing. The reason we like to go over this slide so many times because it's very important during these times to realize that there's two sides to the investment coin. There's heads and there's tails. There's risk on, there's risk off, right? There's bulls and there's bears. And the most important thing for you to remember is that you need to assess where you're at, and we'll talk about this in a few minutes, half the people want to buy and half the people want to sell. All right, kind of puts us in a rock and a hard spot because we know we're going to disappoint somebody, right? For those that you that want to sell, we're not selling fast enough. For those of you that want to buy, we're not buying fast enough. So we will run the portfolios. They will do what they're supposed to do, and we'll explain those in a few minutes and remind you about how they're supposed to be used during these times. But right here, this slide is showing you that maybe you're 50% risk off, maybe you're 50% risk on, maybe you're a 70-30 guy, okay? So we have solutions for both of you. If you are worried and you'd like to become more conservative and tilt your portfolio towards the green side of the equation, the risk off, right? Preparing for more of a bear market in the recession, then we can do that. If you have a longer term time perspective and you're ready to put more money to work, well, we have a solution for that, and we can help you average in, over the next several months. That would be a great strategy, right? If you're looking to deploy money, we can't time the market. I don't know when the bottom is. I don't know if the bottom is passed, but we do know that we can systematically invest, okay, over the next several months and take advantage of these buying opportunities, okay? So reassess. Are you bullish? Are you bearish? Are you in between? Again, communicate this to your primary relationship manager, and we can adjust the portfolios if and as necessary. So another thing I want to remind you of is that using the example of 50% risk on, 50% risk off, all right? Remember that your portfolio is well balanced. So for somebody that is 50% risk on, 50% risk off, let's pretend that you decided to use an annuity to anchor your portfolio. That's a great choice because a fixed index annuity, an FIA, can't go down, okay? It can only go up. So you're automatically doing the right thing. When the market drops, you're not in the market. When the market goes up, you're automatically in the market. Okay, now it's not a perfect investment. It provides some liquidity and it provides protection, but it doesn't provide your upside. So in this case, on this slide, let's assume that over the long run, it can do 4%. Now the red money, and it's the bull, right? The money that's at risk, let's say that's in the stocks. Let's say the stock market can do 7% over the long run. Well, but it might go down 20, right? So if 50% of your money is in each of these strategies, on the upside, you're going to have a 5.5% return. Okay. Now we're not getting that right now, right? We're on the downside of the market. We're in the middle of a firestorm. So if your portfolio is down 20, if that only represents 50% of your portfolio, realize that you're really only down 10%. Now your statement is going to show down 20. When you look at your 401k statement, it's going to show down 20. When you look at your Schwab and TD and Folio and your different custodian statements, they're going to show down 20. But remember that if you had an ABC plan where you have some cash, some fixed annuity or structured notes, okay, or something that protects on the downside, that you need to look at the total portfolio perspective when calculating your total portfolio return, okay? So just something to remember, because a lot of the custodians cannot put your annuity statements on their statements. Schwab and TD do not put your annuities onto their statement, and therefore it's out of sight and out of mind when you're looking at your statements. And right now that's not fun because they've been going down big on most days, and then they go up a little bit. We'll talk more about that in a second. Okay, so always rebalance, or always be assessing things risk on and risk off. Okay, well, let's talk about the markets. Here's the chart of this week, right? Okay, how you read this chart is the left bar is the opening of the market, and the horizontal bar on the bottom is the closing of the market. So on Monday, you see we opened and we closed low. The next day, we opened a little higher, we closed a little higher, right? So this is the whipsaw. We're down 2,000 one day, we're up 1,000 the next day, all right? Well, then the next day, we opened down, okay, and we closed down, and then we opened down again. You know, a lot of people thought we'd get another bump like we did between Monday and Tuesday. Here, we opened down again, and so you see that the bar on the far right, the last white bar is down considerably from the close. So it gapped down. It closed, and then it opened even lower than where it closed the night before. And then you can see that it really fell apart and fell all the way down even lower. So we opened lower, and we closed lower, we opened lower, and we closed lower yet, okay? Now, today is Friday. We're hoping to get this video out to you today. You might not get it until Monday or Tuesday just because of production and the weekend and schedules, but hopefully you're getting this within a day or two. And so here's the close of Friday. So here's today, here's Friday. We opened up higher. I went home yesterday to make dinner for my kids. I loved on my kids a little bit. And between the time I started dinner and I cleaned the dishes up, the market was in the after-hour futures markets were down 700 points. Okay, I put the kids down to bed, went back to the computer, and then they were up. And by the time I decided to finally call it a night, they had gone up to over 700, and then they opened here nicely today. Then we had some news events that happened, and we see a big dip there about, hard to see on the screen here, about 8:45. The market climbed back up, it turned sideways for the day, and then look at what it did at 12:30. Between 12:30 and the close, we shot right back up, and this is the S&P 500, by the way, and we're up about 9% here on this chart. So again, we really finished the week off well, and we started the week off horrible. We ended the week high, so everyone can have a nice weekend. I'm glad the markets are closed. I'm going to get a full night's sleep tonight. I won't have to do the sleep between 2 and 4 shift at least for a day. So that's how the market ended up. It's been a roller coaster. Your emotions have been up and down, and so that is what we just went through. Now, this chart here is showing you the fear and greed chart. And this is right now one of the best indicators to determine what the market's going to do. And you see the red bars on the far right. That's the fear indicator. And I believe this was a record low, an all-time record low as far as the fear went, right? I think over the last couple of days, we have really, as the news has come out, as the Fed have made announcements, we've had all kinds of events this week. You know, I think you got the video from last week, but I woke up Monday this week, and we had Saudi Arabia in an oil war with Russia. We had North Korea shooting missiles towards Japan for tests. We had the 10-year hitting the lowest records ever. We had the coronavirus at full peak, and of course, that's why we opened so low on Monday. And so here, this week has just been an announcement after an announcement. Up here, we're in Seattle. We're in the epicenter of the coronavirus, and our kids aren't going to school for 6 weeks, and it's pretty tough, right? So we really hit this peak fear, and this is indicated here by those down red bars. Now, an indication that it might be time to buy a little bit more is when those red bars go back up and they pass that 0 line. That would be a strong indicator, a technical indicator, that we might want to put a little bit of money back to work. So we believe that we still are going to have some ways to go. We don't believe that we're out of this yet. If we look at China for evidence, I think it was about 3 months before they, before they got to the backside and started having good recovery rates and starting to get back towards normal. So we probably have a little ways to go, but along the way, we'll probably have some ups. We're going to probably have some downs. And as the fear starts to dissipate, and as we really get some answers questions to the answers that we just don't know. And that's the problem right now, is there's so much uncertainty. We have uncertainty around the coronavirus. We have uncertainty around the economics. We have uncertainty around school, around the political environment, the legislative environment, the Fed environment. There's just, we're in a black swan, we're in a firestorm, and there's just a lot of uncertainty. As the facts become more clear, we'll get more certainty, and this fear gauge will start to come back up, and hopefully we'll see the beginning of a recovery, which I'll talk about in a minute. So anyway, this is the fear. We've hit peak fear on the measure there. And you probably didn't need a chart to tell you, but there's the evidence that we like to look at. We always like to use the preponderance of the evidence, and so we definitely have evidence that the fear is peaked, and we'll wait for that to rebound here. Okay, here's the chart that we like to show you about volatility. And as we've been saying that most of the year that the volatility has been contained, and here you can see that we have this breakout. And I think if you listen to me for a while, you know that I talk about violent volatility. All right, well, this is violent volatility. If you weren't sure, you see we have normally, under normal conditions, the market's going to trade between up 1 and down 1 on a daily basis. That's the range of volatility. Up 1, down 1, up 1, down 1. Well, as you can see from the last few days here, we're down 2,000, up 1,000, down 2,000, up 1,000. It's very severe. Okay, and so the VIX is high, which is a measure of volatility. This is the daily volatility of the S&P 500. It is high. It has violent breakouts, and that's what we're seeing there. We don't expect that to be in this range for a long period of time. We would expect at some point it will come back into that normality range between the up 1 and down 1, but it just may not be happening overnight. It may take a few months for that volatility to dissipate back towards normal. Okay. All right. What drives the market? Again, I hate to be sounding like a broken record, but sometimes if I say it enough, you'll be well schooled on this, and you'll be doing these videos for us. So, 3 things that really drive the market: interest rates, inflation, and corporate earnings. And of course, the 4th thing is the Federal Reserve, and you always want them to have your back. You don't want to fight the Fed. Well, let's think about this. Before the corona or COVID-19 issue or outbreak, interest rates were fine. Inflation was fine, corporate earnings were fine, and the Fed was very accommodative. So we really didn't have any signs of anything to worry about, okay? And this is why this is a black swan event, because on Friday everything's fine, and then by Monday it's not fine, right? It's not. It's just literally this has happened so fast that it's a black swan, right? Okay, so now. This was more of a V. It was a straight down, right? It was a race to the bottom. It was like a V shape, right? Now we would hope to think that the recovery could also be a V shape, because before the drop, it's all been, it was the fundamentals and the things that drive the equity markets were okay. All right, now we are going to have some issues with the GDP and economics. This is a real issue. We are expecting earnings to be down, okay? But we're not expecting earnings to be down for several years. They may be down at this point with the evidence that we have for several quarters, okay? As an example, Starbucks. We're in the home of Starbucks here in Seattle. Well, let's just pretend that Starbucks shut stores down for 3 months. Well, that'll be devastating to the workers, the employees, the company, right? It's going to be disruptive, but they'll survive. And so if nobody drinks coffee for 3 months, they'll be okay. Now, they're going to come back. So maybe they have a few quarters that are really, really bad or rough, okay? We don't know yet. I'm just using this as an example, but they will recover. So again, we don't know how severe it's going to be. The travel industries, restaurants, it's going to be bad, right? We already know of several small businesses here in Seattle that can't make payroll, and that's not good. So there's going to be some economic hardship, and it's going to be tough, right? We expect it to be pretty rough, but we will get through it, and we will recover. And the market, is down so big one day, and it goes up so fast the next day that you need to keep probably some money invested, right? Because when the market decides to turn, if you're not in, it's going to be too late. Just like if you didn't have a good plan before this happened, if you didn't have that ABC plan, a good financial plan, if your portfolio wasn't well allocated by having some safe money, some protected money, and some money in the market, if you didn't have that plan, if you didn't have that parachute ahead of time, you went down. Well, you also have to have a plane ticket, before the market goes up. All right, so that's what we're paying attention to. We think the economics aren't going to be very pretty for a few quarters, and at this time, hopefully, it's not turning into years of economic downturn. So we'll keep you posted on that. On the recession front, beginning of the year, I don't know, maybe we were at a 17%, 20% chance of recession. Now we're definitely getting up a lot higher than that. I think the Bloomberg and the Fed models about 30 to 40%. Other people are calling it 50%. So there, we don't have evidence yet that the earnings are going to be bad because it's a lagging indicator, right? The companies have to announce the earnings. So we suspect that they're going to be, we could hit a recession. And again, like we've been talking about, when we start the year with an expected GDP of 1.8%, it doesn't take a lot to derail the economy. Again, a recession is just two consecutive quarters of down GDP. So, we may not go into an official recession, but still have a lot of hardship. So, and the market can still go up and down whether we're in a recession or not. But that's what a recession is. And it's no secret. You don't need me to tell you that the probability and the feeling is that we're a lot closer to one now than we were a couple weeks ago. So we'll keep you posted. All right. Well, what did we do? Well, what we did, for a lot of people, they had a financial plan. They had an ABC plan. If you have a financial plan, then you weren't blind going into this, and that should make you feel really good. We also have been reacting reasonably. Okay, we didn't move everything to cash, and we just didn't go out and buy in the first dip. Right? We are assessing the situation professionally as a fiduciary. We're using the preponderance of the evidence. We're using all of the tools and skills that we have. We have vast networks of friends and professionals around the country. Again, my New York resources and friends and colleagues are up at 4. That's why I'm up at 4. We're talking and we're getting the jump on the day. So we're acting very reasonably. And again, I wish I could predict the future for you and could tell you what was going to happen. I can't, but I can definitely promise you that we're going to make the best decisions we can. And if they're not enough, we'll keep adjusting. Okay, we don't just make a decision and say, well, I hope that was good. Let's come back in a year and see how we did. Nope, we're very adaptive. We're active. We are going to make you that promise that we are going through this with 2 eyes wide open, and we've got your back. Okay, we've also added cash to a lot of the portfolios. We've also shorted the market in some of the portfolios. When we say we short the market, it means that we make money if the market goes down. Okay, so that's a good thing in this market. You make money when stocks go up. You can make money when stocks go down. Excuse me. So one thing to remember, though, is that when you're hedging, right, when you're hedging your bets, if we were 50% long and 50% short, we're guaranteed to be wrong. Because when the market goes up, half the portfolio goes up and half the portfolio goes down. So on the up, you're half right. On the down, you're half right. So we're not perfectly hedged, but we are hedged, okay? And so that means that on the down days, we are performing better on the down days, and we're going to give a little bit up on the up days. And we think that's prudent and reasonable during this time. So again, we're more in a protective defensive mode than we are in let's just go get return and really take that risk and try to chase those returns, okay? We're not chasing returns. We're following our plans. We have a playbook, okay? And we're going to do much better on the down days than we are on the up days. For an example, what does that mean? Well, this is for illustrative purposes only, but if the market goes down, we're hopefully going down half of what the market does. When the market goes up, we're not going up more than the market. We might be going up 60% of the market or 75% of the market, okay? So that's a good scenario. You go down less than the market And when it goes up, you still go up, but you don't have to go up as far and you still do okay. Remember, that's called negative compounding. And remember, what goes down 10% has to go up 11.1% to break even. What goes down 50% has to go up 100% to break even. So if you're not going down as far, you don't have as big a hole to dig out of on the upside, okay? So we've also repositioned the portfolios to be more defensive. And we continue to adjust the portfolios as the facts unfold, okay? And we'll continue. We've traded every day this week. My staff and our traders are on overload. We're drinking lots of Red Bull. We're eating lots of pizzas. It's like we're back in college. It's Red Bull and pizza week, okay? If you guys want to send some Red Bull or pizza to the office, we'll take it, okay? It might help us do a better job for you. And I'm really excited. I'm wired. That's probably why. I thought it was the Holy Spirit, but maybe it's the Red Bull. So anyway, we got our eyes wide open. All right, so on the right-hand side of the screen, you see the focus growth. Focus growth is our stock portfolio that can go to cash, okay? So it's looking to hold about 10 stocks. It's looking to get those Amazons and the Microsofts and the Googles and the Visas, and it's looking to get those good growth stocks. However, it can go 100% to cash. Before the COVID-19 episode, we had around 13% cash in that portfolio. Excuse me. As the facts and data unfolded, we increased that to 30% cash, okay? And as the facts and circumstances changed, we've now moved that into the 60% range, okay? So we've gone from 13 ahead of time, which was good, to 30 to 60. Now on Monday, and next week, you may get a video where I'm telling you, we're now 100% cash, okay? So that's normal. That's what we're doing. We're adapting. And again, you notice that we didn't just go all the cash right away. We're going to be prudent about it, okay? So that is the focus growth. We added cash, and we're in that 60% range. The focused dividend portfolio, okay, is a focused, it holds 10 stocks. It's focused. Okay, and it's looking for dividend yield. Now, this portfolio by mandate doesn't go to cash because when you want dividends, you don't want me selling the portfolio out from underneath you. Right now, you're going to get about a 5 to 6% dividend yield, and you want that dividend yield. So we do not go to cash in that portfolio. Therefore, when the market goes down, it will go down like the market. However, when the market goes up, it will go up like the market. All right, so it's going to be fully participating in the ups and the downs. The focused growth is going down way less than the market because we've got a lot of cash in it, but therefore it also will go up less when the market goes up. Okay, now we like recommending splitting those two portfolios. So maybe you started the year off 50-50, maybe now you're 65-35, maybe you're 70-30, whatever's appropriate for you based on your relationship manager's recommendations. So we like using both. So let's just think that you have 70% in focused growth. That's great. It can go to cash. And then you have 30% in the focused dividend that is fully participating. So in essence, that's another way to hedge, right? You're going to get some of the market upside and you're going to lop off some of the market downside, and you're being reasonable, okay? Now, the asset allocation approaches, we have several different asset allocation models. The most popular right now is the sailboats and the tugboats. And so both of those have had adjustments made to them as appropriate. So in the sailboats, where it's appropriate to short the market, which means we make money when it goes down, we've increased our short position. We've increased cash. We have gold. We have palladium. We have managed futures. We have real estate, okay? We have a little bit of technology, which has been doing well, believe it or not, this year. And then we have only 5% exposure to the S&P 500. So it's a well-diversified portfolio. It can go down, it can go up, but again, the goal is to chop off. That's a professional term, by the way, chop off. I learned that in finance school. We're trying to chop off the majority of the down and participate on the up. So those are well positioned. And again, I've traded those several times. We will continue to make trades as necessary as the story and facts unfold. The last portfolio that we'll talk about is our focused bond portfolio. Now, the important thing to remember here is that it's an individual bond portfolio. So even though you can see the bonds go up and down every day, if we hold those bonds to maturity, unless there's a default, you know what you're going to get. So it's a very safe and secure portfolio. So again, it can go up and down. You'll see your statements go up and down, but the way we manage it, we know if we hold it to maturity that you will not have a loss unless there's the company goes out of business. Okay, so that's the focused bond portfolio. So again, we're very proud to be serving you. We're very happy to be confident in these times. We think we have a great plan. We think we're making good adjustments to the portfolio. Now, of course, I don't know what's going to happen. So can I always do better with hindsight? Of course. With hindsight, we'd all have our own island somewhere, but we don't have the luxury of hindsight. We don't know what's going to happen tomorrow, but we're adjusting quickly. We're taking good care of you, and we'll continue to adjust as necessary. Now, that's what we're doing. What should you do? Well, it depends if you have a long-term perspective or a short-term perspective. It depends if you're one of those people that wants to buy or one of those people that wants to sell. So reassess your risk, okay? Make sure you know who you are, and then we can adjust the portfolio. So as it says here, 50% want to buy, 50% want to sell. In one conversation, we're talking to you and you're saying sell, and then the phone rings again and the next person says buy. So both of you are right. Excuse me. We can accommodate both of you. For those of you that really want to put money to work during this dip, excuse me, we would be putting money in the focused dividend portfolio because the dividend portfolio will stay fully invested. So if you're willing to go up and down with the market, then we want to get you into the dividend portfolio. You wouldn't want to, if you're really trying to invest and buy the bottom, excuse me, if you invest in the focused growth portfolio, because it could go all to cash, you may not be getting what you wanted, okay? So make sure to talk to your relationship manager about what you want, and they can give us orders to reposition you that will make you comfortable, okay? Now, you can also reposition the portfolio from annuities to equities. For a lot of you that have fixed index annuities, remember the perfect investment, one of the attributes is liquidity. So a lot of your annuities have provisions where you can take out 10 or 20 or potentially more of those proceeds that have been protected, that have not gone down, right? So you bought high, you're pulling the money out high, it has not had a loss, and you can buy low. So isn't that what we're all trying to do, right? Sell high, buy low. So you may want to discuss transferring money from annuities, taking a small withdrawal, and putting that into an equity portfolio to take advantage of the market. Now, let's say that you pulled out $100,000 from your annuity and you want to put it into equities. We don't have to just put that in all at once. We can average that in over the next several months or a couple months, okay? So again, I don't know if or when the bottom is here or when it's going to come or if it's gone, but it's prudent and reasonable to average your cash into the market over the next several months. Now, excuse me, I've been talking since 4 o'clock this morning, and it's not the coronavirus, luckily. It's just a dry throat from speaking and communicating all day. But for those of you that haven't had annuities and you have cash or CDs or other assets that you'd like to rotate into the equity markets, we can do the same thing. Okay, so we can reposition you into equities, or we can even reposition you into the asset allocation, which isn't quite as aggressive as the market, okay, but will still be buying low and buying in when you want to. So that's always repositioning assets is a good strategy during these times. If you are withdrawing money regularly, okay, raise a couple years of cash if you need to. Make sure that you have enough cash or a year's worth of cash that you don't have to ask us to sell something when the market's down, right? Put that cash, we'll put it in a money market for you, or we can hold it in your sweep account. You can put it in your bank account. But if you're requiring or needing or wanting to withdraw monies from your portfolio, then let your relationship manager know. We can raise some cash, put that on the side, and that will let you sleep sleep well, because if you know that you've got all the money you need to pull out of the portfolio for the next 2 years, okay, then you don't have to worry about the market going up and down every day. Okay, so that would be another way to provide some security to your income and allow you to sleep well at night. And when will this be over? I don't know. History would say that 2 or 3 years from now, we're going to look back and we're probably, the market's probably going to be a lot higher, and we're probably going to be wishing that we had the guts to go into the market and put all of our cash to work. Now, I'm not saying that's the right thing to do, but again, that with hindsight, that's what we'll be saying probably in 3 years. So over the next 6 months until we get out of the election, we're going to probably have a lot more volatility. So again, make sure you have a good ABC plan, a good financial plan. Make sure that you have reassessed your risk assessment. And then most importantly, make sure that you're communicating that to us with your relationship manager, so that if we need to reposition the portfolio by adding more risk assets or by de-risking the portfolio, we can do that for you. So again, I apologize for going a little bit longer than I planned on, but I hope this was helpful. I'm going to be working and researching all weekend for you, so I'm sure I'll be talking to you soon. So as we started off, don't worry, stay calm. And I hope you can have a great weekend, and I hope these are helpful. If they are, please let us know, and it'll encourage us during these tough times to continue to make more for you. If we're over-communicating, let us know too, and maybe we won't do one next week. So anyway, thank you so much again for being with us. Thank you for trusting us. It's our privilege. I love doing this. This is my passion, and so I thank you for allowing me to do what God gave me to do. So have a great weekend, everybody. Again, this was Joe Mass. Thank you so much.